So some things we'll talk about with Chapter 8. We'll talk about classes of receivables. We're going to talk about how you account for uncollectability of receivables. There's a couple of methods to do that. Direct write-off and allowance are the two big methods. We'll compare and contrast both methods to each other. We'll talk about notes receivable and accounting for those, and also account for receivables on the balance sheet. And then, as usual, we kind of finish up with some ratios. Okay, first we'll talk about just the common classes of receivables. The first one you see here is accounts receivable, which is really common. Most businesses that buy and sell to other businesses on account will have these, and typically they're short. 30 to 60 days is a fairly common time period to have a receivable on the books. Next is notes receivable, which is usually evidenced with a formal written agreement, typically signed by the parties involved, and there's it's formal credit that has been given from one business to another, and typically then there's going to be interest involved with a note receivable. And then we have other receivables, just any other receivable that we might have on the books, typically collected within 1 year or less, and then typically counted as a current receivable then, so it's a current asset on the balance sheet. Some examples that you can see here are interest receivable, taxes receivable, and receivables from employees basically. So just any receivable that is due within 1 year or less, we treat it as a current receivable or basically a current asset. And so let's talk about accounting for uncollectible receivables. There's a couple of issues we have to keep in mind. It says that companies often sell their receivables to other companies. It's called factoring. The buyer is then called a factor. And the reason you do that is to get cash now instead of having to wait until your collectibles are fully collected from whoever owes you. So it's just a way to get cash in the short term by essentially selling your receivables. It says regardless though of how careful a company is in granting credit, basically it's safe to assume that no matter what, even if you do the best you possibly can to only grant credit to credit-worthy businesses or individuals, you're still going to have some percent of your collectibles will go bad, and we just call that bad debt expense, or also possibly also uncollectible accounts expense or doubtful accounts expense, just anything like that. But typically you're probably going to hear it called bad debt expense more than anything else. So some things to keep in mind when it comes to an account possibly have been going bad, and I can tell you that this will for sure be a question on a quiz and or test for the chapter. The receivables past due. Obviously if it's not past due, it's not going bad, obviously. The customer does not respond to attempts to collect. That's a very good indicator. The customer filing for bankruptcy means we're going to have an issue collecting because that customer is now protected by a bankruptcy court. The customer closes his or her business, and the company cannot locate the customer. So we can't find the person. We know the business is closed, or we know they declared bankruptcy. They don't respond to us, and it's past due. Obviously fairly common sense type of issues. So there's two ways to account for uncollectible receivables: the direct write-off method and the allowance method. The direct write-off method, it says it just records each bad debt expense only when we determine the account to be worthless. Okay, at that point in time, then we write it off. Or we have the allowance method, which records bad debt expense by estimating uncollectible accounts at the end of the accounting period. So basically, we get to the end of a year or whatever the accounting period is, and we come up with an estimate of what the bad debt expense will be. So let's describe direct write-off method and just talk about that one first. Okay. So with this one, it says on May 10th, $4,200 account receivable from D.L. Ross has been determined to be uncollectible. So whatever the factor was, they're not telling us, but we just know we're not going to collect. Okay, And so notice that we are basically crediting the receivable. We are removing the asset from the books, and in its place, debiting an expense account. So basically, expense goes up, asset goes down. We record the expense. Now, that doesn't mean we can't collect it later. We can still collect something. And so we have the direct write-off method here. And it says that the account written off on May 10th is later collected on November 21st. So we can still collect it. There's nothing stopping us from doing that. Obviously, if somebody's going to pay us, we're going to accept it. And so in this one, we basically have to reestablish the asset. We debit account receivable, we remove the bad debt expense, and then we record the receipt of the payment. So we undo the bad debt in the first entry. The second entry, we record the payment just like we would record any normal payment on account. Okay, next is the allowance method. Okay, and this is probably the one that's a little bit more accepted. It says on December 31, X-Tone Company estimates a total of $30,000 of its $200,000 balance of their account receivable will eventually be uncollectible. So basically, we get to the end of an accounting period, and it's pretty common that we wait. It's kind of an annual type of a calculation. And what we do is we go through some procedures and we make an estimate, and again, it's just purely an estimate, of what we believe the current receivables will not be collected in the future. Okay, and we make an entry, we record the expense now, and then we create an allowance account. It's a contra asset account, so allowance for doubtful accounts. So notice that assets normally have a debit balance, but now we've got a contra asset account with a credit balance. Okay, so we've got a credit to the contra account and a debit to the expense account. So with the allowance method, it says the net amount expected to be collected is $170. The net realizable value is what they call that. So it's $200,000, which is basically our debit balance of account receivable, less the contra account, the allowance for uncollectible accounts, and the two together, a debit of 200 and a credit of 30, obviously adds up to be 170, which is the net realizable value of our receivables. So to continue with the allowance method, it says that on January 21st, John Parker's account of $6,000 is written off because we have determined that it's uncollectible. Notice that the entry, though, is very different than the direct write-off method. We've already made an estimate of what we believe future uncollectibles will be. And so now we are writing off one of those accounts that we thought might go bad. And so we have already written off the expense. We've already recorded that. And so now we reduce the allowance. Okay, so instead of crediting the allowance account, now we debit the allowance account as we specifically write off accounts. So we debit the allowance and we credit the account receivable for John Parker. So to compare and contrast the two methods, the allowance method basically says it says the adjusting entry fills the bucket, right? Basically, we credit this allowance for doubtful accounts and we fill it, okay? And then every time we do a write-off, we reduce it. We empty the bucket a little bit, okay? So the adjusting entry is to debit the bad debt expense, credit the allowance account, and that's my adjusting entry. That increases it, and then every time I do a write-off, I debit the allowance and I credit the actual account receivable, and that empties the bucket. So to continue with the X-Tone Company, it says during 14 they write off $26,750 of uncollectible accounts, including the $6,000 that belonged to John Parker, the one we just looked at. And it says after posting all entries to write off uncollectible accounts or amounts, allowance for doubtful accounts will have a credit balance of $3,250 because we had the original balance of $30,000. Then we had the debits, which were the actual write-offs for $26,750, with a leftover amount of $3,250. It says if X-Tone had written off $32,100 in account receivable, the allowance would then have a debit balance. So basically we wrote off more than what our estimate was. So it can end up either way, as a credit or a debit. To continue with the allowance method, it says that Nancy Smith's account of $5,000 was written off back in April, and then in June we collect it. Okay, so just like the direct write-off method, once we receive a payment for an account that was written off, we have to reinstate the original receivable and then make a second entry to record the receipt. So basically we undo the write-off with the June 10th entry, we debit account receivable, and now we credit the allowance again, and then on the second entry on the 10th is we debit cash and then credit the receivable. It says that the allowance method requires an estimate of uncollectible accounts at the end of a period. And there's two methods that we used to come up with that estimate. And this is kind of the first real item that we've come up with in our class that involves an estimate, besides a few things regarding depreciation. But just so you know, accounting does have a lot of estimates in it. We are doing the best guess that we know today of what we believe will happen in the future. And that's what bad debts expense is. We just know that if we sell to our customers on account, it just is going to happen that not everybody's going to pay us back. And we have to estimate what that is for the future. And the reason the allowance method is the best method of the two methods, because the allowance method is matching revenues earned to expenses incurred in the same accounting period, right? I'm estimating or guessing future bad debt expense and recording it today based on my sales or whatever method we'll look at here. The direct write-off method doesn't record expense until we actually do the write-off. Okay, and so that could happen obviously sometime in the future, well after the actual sale has been recorded. So there's a mismatch between the revenue and the expense. The allowance method matches those two things in the same accounting period. So the two methods are percent of sales and analysis of receivables. We'll look at percent of sales first. It says if X-Tone's company's credit sales for the period are $3 million, and they estimate that 3/4 of 1% will be uncollectible. Pretty simple, right? We just base that on history, just what we know about our credit customers, and just based on our experience, basically 3/4 of 1% of credit sales will go bad. And so we just record that now. We're basically saying we had $3 million of credit sales. Let's go ahead and match that up against the bad debt expense, and we'll make a journal entry. Okay. In this approach, this is a key thing here, and when you do the homework problems, you're going to notice this. This approach completely disregards what the balance of the allowance account is for adjustment. Okay, we don't even look at it first. We just go ahead, we take credit sales times the percent, we get a number, that drives my journal entry. And remember, it's only credit sales that we're concerned about. Cash sales are collected, right? There's no worries there. We've got that money. It's just the credit sales that we focus on. Okay, so my next part then is just to make the entry, and it says then to debit bad debt expense, credit the allowance for $22,500, and now the balance of the allowance account will be $22,500 plus the $3,250. And that's what they'll show us here on the next slide. So we had the original balance of $30,000, we did our write-offs of $26,750, and now we add to our new adjustment for the year, and now our ending balance is $25,750. So percent of sales completely ignores what your existing balance of the allowance account is. That's one really important thing to remember. So then we have the next method, the analysis of receivables method. And it says the longer the account receivable is outstanding, the less likely that it will be collected, which obviously makes sense, right? The longer it's gone past due, the likelihood of collecting goes way down. And so we make an estimate based on the aging of receivables. The older the receivable, the least likely we are to collect. And so there's a few steps that we'll have to follow to do that. And so we apply it in about 6 steps. We look at the due date of each receivable. That was step 1. Step 2 is what are the number of days the account is past due. Step 3 is each account is placed in an aged class according to days past due. Step 4, we do a total for each age class. In step 5, we multiply each age class total by a factor, by some percent. Obviously, that percent should be based on something. Typically, it's based on experience from our history. And then finally, the last one, estimate the total uncollectible accounts and as the sum of the uncollected accounts for each age class. Okay, so it's easy to talk about it. It's going to mean more when we look at an example, so we'll do that here. It says that the preceding steps are summarized in an aging schedule. It's called the aging of the receivables process. Aging of receivables. Okay, so here's just a picture of what we're talking about. We just list every customer that's basically has a credit balance with us, what the balance is, and then if it's past due or not. If it's not past due, it's just in this first column. So obviously we don't have to worry too much about that one. If it is past due, how past due is it? And you can see we rank it in 30-day increments for a while here. Then once we get past 90 days, our increments are a little bit bigger, 91 to 180, and then 181 to 365, then anything over a year old. Then notice that we total that up, and then we apply a factor or a percent based on how old it is. And notice that the percent goes significantly higher the older the account is. Over a year, we're basically saying 80% of whatever is more than 1 year past due will not be collected. So that gives me then a grand total of 26,490 of what I believe my uncollectible accounts will be. Okay, so taking into account how past due is the account. So the estimate based on the age of receivables is compared to the balance in the allowance account to determine the amount of the adjusting entry. So basically what that means is we do look at what is in the allowance account now, because we're basically basing this on our receivables balance. Okay. The previous example, percent of sales, looked at our revenue numbers, our credit sales number. Now we're looking at the actual balance that's due, basically that account receivable balance. We're taking account receivable and slicing and dicing it by aging of days past due. Okay, and because of that difference, we do look at what the current balance of the allowance account is. Okay, we do look at that now. Okay, so we came up with that the balance should be 26,490. My aging, I came up with 26,490. And I go ahead and I look at what's currently in my allowance account. It's 3,250. But I'm saying the new balance should be 26,490, not 26,490 plus 3,250. So because I want my balance to be 26,490, I have to subtract what's already there, the 3,250. So my new entry is debit the bad debt expense, credit the allowance for 23,240, and now my new balance, which we'll see in the next slide, will be 26,490. You can see it right there. Okay, so that's one really big significant difference between percent of sales and analysis of receivables, and you've got to know that one because that's going to trip you up on the homework if you don't know it. Okay, so that's really important to remember. It says then if Extone Company's unadjusted balance of the allowance account had been a debit balance, we would then add that. Basically, the amount of the entry would be 28,590 because then we'd have a credit of 28,590, the debit of 2,100 to get down to my ending balance of 26,490. So basically look at what is currently in the allowance account. If it's a credit, subtract it from our calculation. If it is a debit balance, add it to our calculation. So we want to get down to that number we calculated. However, whatever I need to get there is what I need to make the entry for. Okay, so I have to take into account what the existing debit or credit balance of the account is. So to compare each method, percent of sales and analysis of receivables, you can see here the top one is the percent of sales. It says estimate emphasizes the income statement. So I completely focused on my credit sales and I apply a percent and I make my entry. Done. Okay. The analysis of receivables focuses on the balance sheet and we look at what's my current account receivable balance and I slice and dice that based on aging of receivables. That then gives me a number, once I calculate that number, of what my allowance account should be. Okay, and so I need to take into account what is the current balance of my allowance before I make the adjusting entry. So it's a very significant difference between the two. So now we will do the comparison. I mentioned that earlier, that we'll do a comparison. And so here's just entries for both methods and what they are. Okay, so direct write-off versus allowance. And then allowance, remember, we could use either percent of sales or the aging method, either one on the allowance side, versus direct write-off. Okay, and so direct write-off, basically, I know that an account is past due, I write it off. Okay, I debit the expense. On the right-hand side, once I determine it's uncollectible, I don't debit bad debt expense, I debit the allowance account. Okay, that's one significant difference. We're going to do some collections. You can see what those entries are, and so on. So just basically, we only record bad debt expense on the right-hand side under allowance when I make my annual adjusting entry. On December 31st, I make my adjusting entry. I don't make an adjusting entry for the direct write-off method because I've just been writing off accounts as they become uncollectible. That's all I've been doing. Okay, so that's one big difference. And so here is just a good summary then of some of those differences. You can see it says direct write-off method, bad debts recorded when that specific customer account is uncollectible. We don't use the allowance account. It says primary users are small companies and companies with just a few receivables. The allowance method uses an estimate based on either that percent of sales or analysis of receivables. We do use the allowance account. Larger companies and those with large amount of receivables, because the allowance methods will allow you to match revenues earned to expenses incurred in the same accounting period, whereas the direct write-off method just won't do that. But again, if you're a small company or just have just a very few amount of receivables, you don't really have to go through that allowance process. That's close enough. So actually, it is not uncommon to use the direct write-off method. It just depends on what your situation is. Okay, the next topic then deals with notes receivable. It says describe the accounting for notes receivable. So some things to think about a note receivable. It's also called a promissory note. It's a formal written document containing a promise to pay. Some characteristics would include a maker, basically the party making the promise to pay. So one party is promising to pay the other, that's the maker. The payee is the party to whom the note's payable. They're going to be receiving the cash, receiving the payment. And the face amount is the amount the note is written on for its face. Some other things to think about. Issuance date is the date the note is issued. Due date is the maturity date, the date the note is to be paid. Terms of the note is the amount of time between issuance date and the due date. That's the term, so it's a time period. And the interest rate is the rate that must be paid on the face amount of the loan, basically, for the term of the note. So we're going to pay an interest rate based on the term of the note, how many days it's due, and then make our payment. So an example of a note looks a lot like a check, right? It's very, very similar. It kind of contains some of the same information. So the first item is the maker down here, right? Basically, this is the company that's going to be paying. The payee is who will receive the payment. The face amount is $2,000, right? That's basically how much will be paid. The date of this note was issued on March 16th. The due date is in June 14th. And then the term is 90 days, and the interest rate is 10%. So that's a very common example of a note. So the maturity value is the amount that must be paid at the due date, which includes the face amount of the note plus interest, so that $2,000 plus any interest. So then the question becomes, what's the due date of a 90-day note, dated on March 16th. Okay, so you just have to look at the days in a month. So that's kind of one of those things you probably pull up a calendar to look at if you don't remember. So March has 31 days, which happens to be March 31st. Minus the issuance date of the note, which is 16. That leaves me 15 days. And then I go, what are my days in April? 30. Days in May, 31. And then basically, how many more days do I need in June to get to 90? Okay, so that's a really easy way to do it. Whatever month it was issued in, however many days are in that month minus the date issued, and just keep adding days until you get to 90. Okay, so basically this note is due on June 14th. Okay, another way to do this, it says total days in note are 90, subtract the days in March, add the removal date, that gives me 15 days in March, add the days in April, add the days in May. Basically what's left over is 14, so it's June 14th. Either way works. The first way to me makes a little bit more sense just intuitively to me. Doesn't mean it doesn't make as much sense to you, but that one makes the most sense to me. Okay, so the due date of a 90-day note, basically you can see we've got 15 days in March, 30 days all of April, 31 days in May, all of May, and then 14 days in June. So let's go ahead and account for that. So it says received a $6,000 12% 30-day note. So this is new information. This is a new note. Dated November 21st in settlement of the account of W.A. Bunn Company. Okay, so we go ahead and we debit note receivable and credit account receivable. So basically what's happening is Bunn Company owed us on an account receivable, and maybe they just didn't have the ability to pay us within the due date. And so they said, well, let's just turn that into a note receivable. And as long as we're willing to do that, we'd say fine, because then we get some interest revenue out of the deal. Okay, so note receivables do have interest. So we're taking an account receivable, turning it into a note, is what that first entry was. And then it says that on December 21st, when the note matures, the firm receives $6,060 from W.A. Bunn. It says 6,000 face plus $60 of interest. So the question then becomes, how'd they get that interest? And the best way to think about that is what I call the PIT method. P-I-T, principal times interest times time. Okay, so the principal was 6,000. The interest rate's 12% times time. And when it comes to interest, we go with the 360-day year. So it was a 30-day note that was outstanding for 360 days. Okay, so principal times interest times time. The component is 30 over 360. That gives me $60 worth of interest. Okay, so PIT, principal times interest times time. It says that W.A. Bunn fails to pay the note on the due date, it would be considered to be a dishonored note. The note and interest are transferred back to account receivable. Okay, so basically if they don't pay after 30 days, we basically say, okay, we're turning that into a note account receivable, not for 6,000 but for 6,060 because you owe us the interest. So another example, a 90-day 12% note dated December 1st, 2014 is received from Crawford Company to settle its account, which has a balance of $4,000. So again, an account receivable is being turned into a note receivable, and then this is happening on December 1st, and so we make the entry, and what's going to happen though is we're going to get to the end of the year, December 31st, and of course we'll have not collected the note yet because it's a 90-day note, not a 30-day note, but we've earned interest due to the passage of time, which is what the next slide will show us. Okay, so it says assuming that account period ends on December 31st, so basically we get to the end of December and we make our adjusting entries so we can do financial statements. An adjusting entry that we'd have to do would be to record interest revenue earned but not collected, right? We've earned interest simply due to the passage of time. And so we do the PIT method again, principal of 4,000 times 12% times 30 days. It was 31 minus 1. Okay, so the 31 days in December minus the day 1 when the note was issued, gives me 30 over 360, which gives me $40 of accrued interest receivable on December 31. So I debit interest receivable. I earn the revenue simply due to the passage of time by holding the note. So I've earned $40 worth of revenue. And then we get to the note due date, and we receive payment from Crawford Company. So we get kind of flash forward to March 1st, and we receive $4,120, and that $4,120 is $4,000 principal times 12% interest times 90 days divided by 360. I get total interest earned of $120. However, I've already recorded $40 worth of interest earned back on December 31st. So I can't record 120, I can record 80 instead, 120 minus 40 to get to 80. Okay, so I credit interest receivable, which basically undoes the adjusting entry from December 31st when I debited account interest receivable. I credit interest revenue for what I've earned in 2015, basically 60 days worth of interest in 2015. I credit the principal of $4,000 note receivable, and I debit cash for the full amount I received of $4,120. Okay, and now I'm good to go. I've recorded the collection. So the final thing then is, or not quite the final thing, one more thing before the final thing, is simply to record receivables on the balance sheets. We've got our company here called Morning Joe. We've got just a small slice of their current asset section of their balance sheet. And we start out with cash and cash equivalents. And then we have with that trading investments at cost. Okay, basically, we haven't really talked much about trading investments, but we have a valuation allowance for those. We add to that. That gives me then 465, and then I have account receivable minus the allowance account. Okay, so my net realizable value for my account receivable is 292,700, which is a 305 minus a 12.3. Okay. Okay, I think this is now the final objective, and to talk about some ratios involving receivables. Okay, and so the first one is account receivable turnover. It says it measures how frequently during the year the account receivables are being converted to cash. Basically, how quickly do our sales turn into cash, right? So simply just net sales divided by our average account receivable. When you see an average, it's typically a 2-point average. What was my receivables at the end of the year? What were they at the beginning of the year? The average of those two numbers is my average. And so they're computing that for us right here. We've got 2 years. We've got the net sales. It says I've got my beginning account receivable and my ending number. And then you can see how they compute the average of taking the two numbers, like 3902 and 4692 for year 1, dividing that by 2. And in year 2 is 4692 plus 5191 divided by 2. And then I divide the net sales by that average. And I get 8 in year 2, and I get 8.1 in year 1. Okay. So this tells me how quickly those sales turned into cash. The next one is the number of days sales and receivables is an estimate of the length of time it takes to collect. How long does it take us to collect? You can see it's the average account receivable divided by average daily sales. Okay, and so with this one is you can see I'm taking my average daily sales by taking my sales number, dividing it by 365. So notice we divide by 365 and not 360. We only use 360 when it involves interest. Okay, we're going to use 365 because this involves a full calendar year. Okay, so it's easy to confuse those two when we divide by 360 versus 365. We just know when we compute interest, we go with 360. And so you can see what my average daily sales are, and you can see it took basically the number of days sales and receivables excuse me, has gone up a little bit between year 2 and year 1. And that is the end of